This is the week ahead for the week starting Monday, the 5th of May, coming off the back of major volatility in the week just gone, with Mag 7 names reporting, the likes of GDP and ADP coming in weak, a stronger than expected jobs report, and the possibility of the US and China coming together for trade negotiations. Certainly, there's plenty to look forward to ahead of a week that then focuses in on rate decisions from the FOMC, the Bank of England, and some jobs data coming out from New Zealand. So, as we always do, let's focus first and foremost on the big picture. So these are the top tier events according to Trading Economics. You can see kicking off on Monday with the ISM Services PMI number. It comes off the back of the manufacturing reading in the week just gone, where in actual fact, it wasn't necessarily as bad as people had expected on that manufacturing PMI. Certainly, it felt like the sort of inflationary pressures cooling a little bit after seeing major upside for that recently. But certainly as we go forward, these ISM numbers are going to be very key. Then Canada on Tuesday, the balance of trade data, the IVPMI. And then Wednesday, we really start to kick off. FOMC meeting on Wednesday, the Bank of England decision on Thursday. And then we wrap up the week with some data coming out of China, trade data, balance trade, exports, imports, and then unemployment. So the jobs report out of Canada. So certainly a busy week to look forward to. And we're going to kick off with the US region. Like I said, we've seen a very busy week just gone, certainly focused around the GDP figure, which came in at minus 0.3 for the first quarter. That means that essentially we're looking at the possibility of a recession coming into fruition in the second quarter. So certainly the fact that we saw that negative reading sort of lays us up for what looks like is likely to be a recession, given the fact that we're now currently in the second quarter. And of course, we still have the sort of breakdown in trade between the US and China, and like certainly a lot of uncertainty, and businesses probably holding off on much of their spending and investment as a result. In terms of the ISM numbers, I just wanted to bring those up and see exactly how they came through, just to give you a bit more granular detail on it. So the manufacturing PMI did decline, but not as much as expected. The employment figure actually rose, but still in contraction territory, but certainly better than expected on both of those. The new orders figure came in higher, so that could be a case of maybe some front loading, but we're in April, so it really depends how early in the month this was taking hold. And then we saw the prices figure, which was at 69.8. It did increase, but not as much as markets had expected. So inflation still is a concern, but we did see the core PCE price index coming out recently, and that certainly wasn't necessarily as bad as we thought it would be. In terms of the inflation picture for the US, it still remains under control for now. You can see the core PCE price index figure 2.6 for the year-on-year metric. That's after a 0% figure for the month of March. Maybe it's going to change significantly in the months ahead, given the whole tariff issue that we're facing at the moment over in the US. But the big event for the week is going to be the FOMC meeting. Now, we're not expecting to see the Fed move. And certainly coming into the Friday jobs report, there had been some question marks about if this is weak enough, maybe we could see the Fed move. But in actual fact, that's not necessarily something that now markets are looking out for as a likeliness. Now, certainly if I'm bringing up, say, the expectations, I've just realized that I don't think I've loaded it onto these charts. No. So first and foremost, we can sort of look at that sort of bigger picture in terms of the direction of travel for the US economy. And there's so many different ways to look at this. I mean, we've seen a number of metrics that point towards things not being as bad as you might think. So the jobs report is one. We've seen other things that are like the GDP number. So the challenger job cuts figure, seeing a little bit of a worrying picture with ADP as well. That was particularly weak. We saw a weak GDP figure. So there has been weakness, but there's also been some better than expected reading, and some of it's going to be coming down to the front loading of purchases. So a lot of the data recently has been a little bit better than expected. And you can see that with this Citibank or Citigroup Economic Surprise Index, which is the yellow or orangey line, depending on how your eyes work. And we saw a bit of a bump back towards that middle threshold, towards that zero mark. Now it's starting to fall off a little bit. But certainly the direction of travel in terms of the US economy, how is that sort of tying up in terms of the relationship between that and, say, the 10-year, that and the likes of the US dollar? Well, by and large, generally, these all move hand in hand, right? So we should see weakness in terms of the economy leading to weakness in terms of the 10-year yield and weakness in terms of the US dollar. Well, how have these things been playing out? We've seen a divergence in terms of the US dollar against the 10-year recently. And so people are talking about, is that relationship broken? And in part, this is, it's the idea that like things have changed towards a sort of like US exceptionalism is over. We're potentially going to move to a phase where people are looking for sort of havens elsewhere in the world. The ramping up in debt over in the US is a particular problem. People aren't necessarily going to demand US treasuries in the same way as they did in the past. So if there's a risk off move, would they head into US treasuries? Would they head into the US dollar? Or will they just go for something like gold? Because Donald Trump's essentially fighting a trade war against them. So a number of different questions. It feels like those fears are easing now and that relationship starting to improve, and we'll show you that in a sec. So just quickly, I'll look myself at the FedWatch tool. So markets expect this time around, especially after this report, 99% chance that we keep rates steady this time around. Then when we look further out, the meeting after that, which is in June, you can see that markets are expecting to see a rate pause, but that's only 55% chance. So high likeliness of a rate cut in June, and then July is where we're expected to see things kick off. Certainly markets coming into the jobs report had priced between 100 to 125 basis points worth of easing for the rest of this year. Just going to quickly look at it because I'm waiting until that jobs report to then look at exactly what markets are expecting. So it has shifted. So markets continue to keep the base case scenario as 100 basis points worth of cuts. But now that is sort of a coin toss, right? Arguably, it's now between 100 basis points or 75 basis points. So markets are easing those calls for additional rate cuts from the Bank of England. And that's because we saw a better than expected jobs report in terms of unemployment, or U6 unemployment coming in lower than expected at 7.8. The payrolls came in higher. And actually, the wage growth figure was lower as well. So it was all round a very good jobs report for those that want to see a strong US economy, but not necessarily great for those thinking we need to see a raft of rate cuts, because that's been trimmed somewhat. And so let's look in terms of the market expectations impact on the US dollar. So let's first and foremost get rid of this one so we can just look at it a bit more closely. So you can see that we've seen a bit of a pop initially. That's starting to fade a bit. And so I wanted to bring on the Euro 10-year against the US 10-year yield. This is. And so what we're talking about is this idea that we've got a very close trend that appears to have broken, right? So you can see this trend, right? Very clearly. Sometimes it takes a bit of time to adjust so that it sort of looks right. But you've essentially got a clear-cut trend, both of them generally moving in tandem. And then more recently, we saw this big spike in terms of relative yields. That's the US yield rising relative to the Euro yield. I've inverted them. So a rise in terms of US yields, but a decline in terms of the US dollar. That's not normal. And so what's notable here is that we've actually, if you look at the hourly time frame, just over the past week or so, I'd say, started to trade hand in hand once again. So what does that mean? Well, if we saw a FOMC meeting that points towards additional rate cuts, then we'd be looking at the possibility of additional downside in terms of the 10-year yield. So if we saw downside in terms of the 10-year yield, what would be the impact in terms of the euro against the US 10-year yield? Remember, I've inverted this just to make things a little bit more confusing. So the US yield is at the front end of this ratio here, right, on this chart. So if we see a FOMC meeting that points towards higher rates, i.e. less rate cuts, you'd likely see upside here, right? And more rate cuts, you'd be looking at downside here when you're looking at the ratio between the 10 years in Europe and the US. And remember that the euro is the biggest determinant of dollar index, right? So it has the biggest weighting. So essentially, a strong economy should be good for the US dollar right now. And certainly a the haven role of it is less important compared to the idea of whether we're going to see that shift in terms of mentality from the Federal Reserve next week. If we see them coming out with comments that signal they're going to be ramping up rate cuts, which is what markets have been expecting of late. And I think they're getting a little bit carried away, quite frankly, because we haven't actually seen anything. And also there's a possibility that Trump just suddenly changes course, which is now something that we look like we might be seeing. The more things start to improve and look good, then right now it looks like that relationship in terms of yields should provide the basis for the US dollar to also find some strength. Now, if we're just looking at the US dollar in its own right in terms of from a technical perspective, we can see, let's go on to say that weekly time frame, you can see here that from a long-term, this is the monthly, from a long-term perspective, we have got this long-term uptrend in play. And we've seen this sharp sell-off, and it's come back into an area where, are we at 61.8? Are we, retracing this move before we move higher? Are we simply going to continue on this vein but we're just seeing these wide swings? Well, I just think that right now, the way that things are looking, there is a good chance that we do see a little bit of a rebound. And certainly, if we were to see things improve in terms of the US standing with their partners, with their trade partners and the Chinese, then, it's a possibility that we could see a little bit further upside to come from here. But I think a lot of it's going to come down to, what's the perception of the US economy? What's the perception of the outlook in terms of trade deals and the like? And what's the perception of the Federal Reserve? And that's going to tell us whether this short-term rebound is going to come into fruition or not. Next up, let's look in terms of the UK economy. Let's see here. So here is the outlook for the UK. And what we can see here is that, of course, the main event comes in the form of the Bank of England interest rate decision on Thursday. 25 basis point cut being priced in by markets right now. And that is overwhelming. I mean, you can see the expectation here is that it's going to be 9 out of 9 members voting for that cut. And so the question mark here is, what's the outlook for the UK economy at the moment? Of course, much of it revolves around relations with the US. And in actual fact, we thought, we've got scot-free just 10% while everyone else was getting much higher rates. Well, now everyone's got 10% apart from China. And so what's the impact on the UK economy? Certainly there's been a lot of talk about the possibility of a breakthrough in terms of a trade deal between the UK and the US, but that's not necessarily coming to fruition right now. We've also seen some data on Friday, which is industrial production, manufacturing production, and the like. So again, like I said, it seems like markets are essentially pricing in that rate cut so far. It's just going to be a case of how much more are we going to see from there onwards. This is the outlook for the UK PMI as things stand. You can see that we've seen a downturn of late, notably with a decline for the services PMI down through that 50 threshold. So now denoting a sector in contraction. So both services and manufacturing in contraction in the UK. That could point towards possibility of the Bank of England needing to step up to the mark, or it may be a relatively short-term move. Here's the outlook according to Refinitiv in terms of what the Bank of England are expected to do. You can see rate cut in May, potentially a rate cut in June, and then another rate cut probably by September. That's 3 rate cuts within the space of 4 meetings. That is a ramping up of easing from the Bank of England. And certainly, a lot of it's going to come down to how things play out in terms of trade, how things play out in terms of the global economy. The US and China possibly coming together for trade negotiations and the like. It feels like there's a softening of tone here for Donald Trump. And that means that perhaps this is a little bit overzealous in terms of expectations of what the Bank of England is going to do for this year. You can see by the end of the year, expected to be 100 basis points lower from where we are at the moment, 36% chance of a move to 3.5 and a 22% chance of move from 3.25. That seems like a lot, quite frankly. So I think if we're going to see movement in one direction or another, if we're looking at sort of some of the commentary coming up from this meeting, I think it's probably more likely they're going to be taking a relatively steady approach, especially because things appear to be easing a little bit and we've got a better than expected US jobs market at the moment. But of course, things can change quite a lot when you're seeing the imposition of major tariffs coming into play. Now, in terms of the market to watch, I just wanted to bring up the chart for the FTSE 100. Now, it's been on an absolutely incredible run, and you can see that here on the daily time frame, just moving ever higher and trying to regain that crown of being able to get back up to that 89.09 mark. And if we look on the monthly time frame, you can see just how strong this market's been since those lows. It's been a steady creeper, and generally you do have a sort of period where you feel like it hasn't moved anywhere for the best part of 9 months or 6 months, but we do see those pops coming into play. And certainly, we saw that sharp move back. Well, now we're seeing that pop, and it's pretty much reversed all of the Liberation Day declines, the post-Liberation Day declines, and trying to take aim at that next high. Certainly, if we see the Bank of England coming in with a stance that is relatively expansive in terms of monetary policy, because bear in mind, the economy is what it is, right? People are going to believe what they think about it, right? It's not to say that this meeting is suddenly going to make us think that the economy is really good or really bad, right? So the economy is what it is. Certainly the moves from the central bank and the Bank of England will either help or hinder that push higher for the UK economy, UK businesses. And so, hopefully we do see them leading us down a way of lower interest rates and boosting the UK economy. But ultimately, this is a very clear-cut chart. And so it's a case of just following this trend and look out for the creation of higher lows and higher highs, in particular higher lows on the way up. So a move below 8448 would negate it. But until then this trend that has been playing out of late remains in play, and we're expecting to see further upside to come unless that 8448 level breaks towards the downside. And finally, let's just cover the outlook for the New Zealand economy. We've got a jobs report coming up. I think this is particularly, of course, it doesn't necessarily compare to the likes of the Bank of England or the Fed, but I think it's an interesting one, certainly with the whole China story, the heavy reliance on global trade for the likes of Australia and New Zealand and trade with China. We've also got the fact that unemployment has been surging higher on a monthly basis, and that's why this jobs report is particularly interesting. You can see here the expectation is for a move up to 5.2 from 5.1. And if you look at the comparison in terms of unemployment rates, well, we're seeing quite significant gains. When you're looking at these countries, you would say that the rise of Canadian unemployment is pretty much hand in hand with the rise of New Zealand unemployment. Will that force the hand of the RBNZ to continue their easing pathway? Well, that is expected at 66% chance in May. Beyond that, where are we looking to go? So the month after that, expected to see, in July, expecting to see a potential another cut down to 3%. There on out, you're looking at, say, every other meeting essentially, and then we start to get into sort of early to mid 2026. So we're expecting to see easing from the RBNZ. We're seeing a sharp rise in terms of unemployment coming into fruition, and that would likely force the hand of the RBNZ to take action. Of course, you have the optimism around, maybe things in China aren't going to be as bad as you might think, but there's still plenty to play for on that front. And so let's just look, as we wrap this up, at the final chart. And this is one that I often revisit, and that is the Australian dollar against the New Zealand dollar. I always find it a particularly good and interesting pair, because they're both in relatively similar positions, right? They're in the same part of the world, so they're open to similar kind of sort of risks associated with China. But you do have very different exports. Certainly Australia more geared towards sort of the infrastructure spending and the development of the Chinese economy, whereas New Zealand more open to consumption, consumer behavior, selling agricultural goods, selling dairy products and things like that. So what's notable here is, of course, with that weakness in terms of the unemployment rate, in terms of in New Zealand, also the possibility of further rate cuts from the RBNZ. We've seen the New Zealand dollar strengthening against the Aussie, but now we've come into this sort of trendline support, and it looks like we potentially have turned a corner towards a bullish rise here for the Aussie against the New Zealand dollar. Here it is on the daily time frame. So we've seen a strong surge over the past, say, week and a half. Are we going to see us break out from this wider trend? Well, we'd need to see a break up through this level to give us greater confidence, which is, let's get the absolute point. There we go, 1091. Until that breaks, there is still a possibility we're looking at a retracement here, but certainly the sort of timing of it, the sort of area that we've come into, I think it's a good chance that we are going to be bottoming out here. Look out for resistance at 1085 up ahead, which is a 76.4 fib. But certainly This is a really interesting chart to be watching out for at the moment, considering we're coming into another jobs report that likely is going to point towards higher unemployment for the New Zealand economy. And at the same time, you're looking at the possibility of the RBNZ to continue to drive interest rates lower in New Zealand. I hope that's been useful for you guys. Have a great weekend. Have a great week ahead. And good luck trading. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Thank you.